What's up, everybody? My name is Demetri Kofinas, and you're listening to Hidden Forces, a podcast that inspires investors, entrepreneurs, and everyday citizens to challenge consensus narratives and to learn how to think critically about the systems of power shaping our world. My guest in this week's episode is Brent Johnson. Brent is the CEO of Santiago Capital and the author of the dollar milkshake theory, which we discuss today as part of a much bigger conversation about the sell-off that we're currently experiencing in risk assets, the dislocations we're seeing in currencies and currency pairs like dollar-yen, and how Brent is positioning himself, the advice he's giving to his clients, and what he's looking for in order to meaningfully reposition their portfolios as conditions change in real time. Because so much is happening in markets right now, it can feel very challenging to know where to focus your attention, which, incidentally, is why I've brought Brent on the podcast. Because I think his framework around the role of the dollar and its impact on financial flows is crucial for trying to understand what we're seeing in markets and in anticipation of not just a global risk-off event like the one we're experiencing today, but a sovereign debt crisis, which he believes, and I agree with him on this, is where all of this is eventually going. I've recorded and published countless episodes over the last several years in anticipation of the events that are transpiring today. I think we are in the end game phase of what in my view has been a 40-year paradigm of falling interest rates, rising debt levels, low inflation, growing inequality, and peak globalization, all of which I think are in the process of reversing. How that process unfolds and what assets and investments you want to be invested in during this time does not have a straightforward answer. But I think conversations like this one are crucial in helping you think through the steps required in order to get you there. As most of you already know, Hidden Forces is listener supported. I don't rely on advertisers or commercial sponsors, so the second part of today's episode with Brent is available to premium subscribers only. You can access that part of the conversation, as well as the transcripts and intelligence reports to each episode by visiting our website at hiddenforces.io, selecting the episode that you're interested in, and clicking on the premium extras, where you can then sign up to one of our premium content tiers. Since some of this episode deals with investing, it should be absolutely clear that nothing we say on this podcast can or should be viewed as financial advice. All opinions expressed by me and my guest are solely our own opinions and should not be relied upon as the basis for financial decisions. And with that, please enjoy this week's episode with my guest, Brent Johnson. Brent Johnson, welcome to Hidden Forces.
Thank you. Nice to be here.
I think I'm the only podcast that does any type of financial content that hasn't had you on already.
That you may be correct.
I think that's actually true. So there's a non-insignificant portion of the audience that is already familiar with the milkshake theory. Do people call you the milkman or anything like that, or like milkshake man?
Yeah, milkshake man or milkman, or they call me idiot, all kinds of stuff.
So because many people will already be familiar with the theory, I don't necessarily want to spend too much time on it, but I would like for you to just kind of briefly introduce yourself for my listeners and tell us a little bit about what the dollar milkshake theory is, because it's going to be a big part of the analysis that we lean on during the course of this conversation. And I also just want to let listeners know we are recording this on Thursday, May 12th, because shit just keeps breaking and changing every single day. So it's just important to know that based on where this conversation is going to go. But go ahead, Brent.
Yeah. So from a background perspective, I'm in the wealth management business. I have, a couple of handfuls of very high net worth clients where I kind of create customized wealth management solutions for them. Part of that is trying to make money, and a big part of it's trying to protect what we have. And the milkshake theory is really kind of the framework via which I see the world playing out over the next few years. And it describes in more detail how I see a sovereign debt and currency crisis and play out. So a big part of what I do is from a big, large global macro perspective. I try to find like the big trends, the big movements of capital, where they're going to come from, why they're going to come from there. And also, what are the risk factors that I need to consider, when managing these portfolios? And I just think that the biggest risk out there and I've thought this for a while now, is that a rapidly appreciating dollar. And a rapidly appreciating US dollar just creates a lot of problems for the world based on the design of the system. So the milkshake theory was kind of coined as a, humorous way of explaining to many of my clients who are not necessarily financially sophisticated. They're super smart. They're super successful. They've done a great job of running their businesses or building out their foundations or whatever it is. But, they're not necessarily versed in Wall Street lingo and finance. So I am always trying to figure out a kind of a simple way to explain to them what I think is going to happen. And if we take it back a little bit to 2008, I think that's when a lot of people, kind of the lay people around the world, started to understand the power of central banks and the amount of government involvement that happens in markets. And, we all know after the global financial crisis that, governments, monetary authorities around the world kind of flooded the world with liquidity. They bailed out the system, for lack of a better word. And, that went on for a long time. And the point I was making is, in a world of global finance where money can kind of move around and find where it's treated best, it doesn't really matter who provides the liquidity. What matters is who captures the liquidity. And the point I made was that the whole world had mixed this milkshake, but that for several reasons, I thought the US dollar and the US markets were the straw that was going to suck up all of that liquidity. And there's this movie called There Will Be Blood, where there's this oil baron who makes the joke to one of his competitors that it doesn't matter whether the oil's on my side of the fence or your side of the fence. All I've got to do is stick a straw down into the ground and I can drink your milkshake. And so that's kind of where I came up with this analogy is, the ECB has provided a lot of stimulus. The Bank of Japan has provided a lot of stimulus. China has, Brazil has, Australia has. Everybody's kind of in the same situation. But for a number of reasons, I just believe the US has the straw. And if you look over the last couple of years, even, after COVID, they started mixing this milkshake again. They went crazy with providing stimulus and liquidity. But here we are, despite all of the Fed's efforts, despite everything that the Fed has done, despite the helicopter money and all the bailouts, the dollar is sitting here at a 22-year high. And, it's because of the demand that there is for dollars in the world. And, I think we're headed towards this global sovereign debt crisis where I think it's going to become even more exacerbated than it already is. So hopefully that kind of gives a little bit of a baseline of what it is and where it comes from.
Yeah, I mean, right as we're talking now, the dollar index has gone as high as 104.7. So how long have you held this view, Brent, and what is your level of conviction around it?
So I've had it for quite a while. I kind of started talking about the strong dollar back in 2016 and 17, talking about how I thought that, the system was not going to change due to a weaker dollar. I said I thought it would change due to a strengthening dollar. It was 2018 when I kind of coined the term the milkshake theory, for lack of a better one, because this whole theory, it's kind of been a process. It's not like I just woke up one day and had it. It kind of came to me over a number of years of working on it. And I initially thought that we would have a sovereign debt crisis in 2019, 2020. When COVID hit, I thought that was kind of the trigger that would, kick it off. But the reality is that COVID kind of forced the world to work together. It was kind of an existential event, for lack of a better word. And as a result, monetary policy around the world was very much coordinated. Economic policy, government fiscal policy, all were coordinated and kind of worked in union and pushed the problem down the road. So I'm the first one to hold up my hand and say that, I got the timing on this wrong. I think the framework is right. I got the timing wrong. But now I think now that we're in a world that's fracturing as opposed to working together, and because I think that, debt will eventually matter, I think we're now getting into the point where it's going to play out. And so I have a very high conviction level that this is going to play out. Now, that said, there's no way I'm going to be 100% right. Nobody is ever 100% right. The point I've tried to make is that if I'm even a little bit right on this, the implications are enormous for portfolios and for governments and for society as a whole. And so even if I didn't have the conviction level that I have, based on the job that I have, I don't have the luxury of ignoring this problem, which I see as an enormous problem. So the fact that I do have high conviction kind of makes it easier to focus on it. But again, it's one of those things where I just don't have the luxury of saying, oh, well, let's not worry about it.
Why is today different than March of 2020? Why, in other words, can't the Fed, why can't monetary authorities continue to support asset prices, continue to keep the system kind of at an unstable equilibrium?
Maybe they could. Maybe they could come in and repeat the programs and the efforts that they made in 2020. I would never say that's impossible. And I think at some point things will get bad enough where they will come back in and try to do that. The one thing where I'd say where we have a difference today, again, from 2020 is, in 2020, again, it was very much still a unipolar world. There were some tensions, but it wasn't like it is today. We very much have a bipolar situation where we've got Russia and China and some of their allies separating, and the West and its allies kind of separating. We're moving towards two supply chains. There's massive sanctions on Russia now. We're not in that same kind of cooperative arena that we were 2 years ago. And the other thing that's different now, the other thing that is dramatically different is because they provided so much stimulus around the world a couple of years ago, combined with the fact that COVID just crushed supply chains, and then combined with the fact that now we have geopolitical issues, military issues, that is keeping goods, trade, ships, planes from flying and moving and exporting and importing raw materials as freely as they did, call it 2 or 3 years ago. We have very high inflationary pressures. So the main thing that governments around the world are fighting right now is inflationary pressures. If they were to reverse course and stop fighting inflationary pressures and move back to some kind of a easy money policy, and again, some of them still do have easy money policy. I'll get to that point in a second. But if they were to reverse course of what many are doing now and go back to what we were doing in March in 2020, that's going to exacerbate the inflationary pressures, which is the last thing that they want. And then the other thing that I just mentioned is, in 2020, everything was coordinated. Like right now, we very much have divergent monetary policy. The Bank of Japan still has extreme easy monetary policy. The ECB, the European Central Bank, still has extreme easy monetary policy. Now, they've kind of hinted that they may at some point stop that, but as of right now they haven't. But other countries around the world have raised interest rates and have started to tighten monetary policy. The Bank of Canada has done it. The Reserve Bank of Australia has done it. The big problem for the world is that the United States has done it more than anybody else, or is in the process of doing it. And this starts to get a little confusing for people who are not kind of versed in this. But typically when a central bank of a country raises interest rates or lowers interest rates, they're doing that to affect monetary policy in that country, right? When Brazil raises interest rates, it's because of issues that are going on in Brazil. When Japan raises interest rates or lowers interest rates, it's basically germane to Japan. Same in Australia or Canada or wherever it is. But when the U.S. raises interest rates, even though they are doing it because of the needs of the domestic economy, it affects the whole world. And the reason it affects the whole world is that the United States has the global reserve currency. And what that means is that the whole world uses the dollar to trade in. And if the U.S. is raising rates and tightening monetary policy, that typically forces the dollar higher. So if you're in a foreign country and the dollar is getting more expensive versus your local currency, especially if your local country and currency is not in the same strong position that the United States is, now the dollar starts to appreciate versus your currency. But you in your country may need easy monetary policy. But you're not getting it because the U.S. is raising rates and because you do trade in dollars and because you probably borrow in dollars. It's becoming tighter monetary policy for you just when you need looser monetary policy. And so that's the big issue with when the U.S. raises rates. When the U.S. raises rates, they raise rates on the whole world. When the U.S. moves to tight monetary policy, the whole world moves to tight monetary policy because it is the currency for the whole world. And that is much different today than it was 2 years ago, 3 years ago, or even 4 years ago.
So let's actually break this down a bit more, because I think this is the key to understanding your thesis, which is, and I've told you this before, that the way that I kind of think about this, or one of the ways in which I think about the dollar's role in the international financial system and in relation to what you call the milkshake theory, is that it's kind of like a spider's web that spins itself the more you try to get out of it. What is the relationship between debt issuance and liabilities, dollar-denominated liabilities, and the value of the dollar from a demand side?
Sure. So the first thing that listeners need to understand is that there's two different dollar markets. Don't feel bad if you never realize this, because most people don't know it. And most people who've worked on Wall Street for 30 years don't even know it. But there's a domestic US dollar market. And then there's dollars that circulate outside the United States. And they're used for trade finance. They're used for financing. They're used for operational company operations. But there's a huge dollar market that sits outside the United States in banks or shadow banks or non-financial companies outside the United States. Those are called euro dollars. Now, it's not euros. It's not the euro currency, but any dollars outside the United States are referred to as euro dollars. And that market, the euro dollar market, dwarfs the US domestic dollar market. And so, to your point, the spider's web, here's where it gets really kind of interesting and murky and opaque, is because there is no US regulator that has jurisdiction over the euro dollar market, which sits outside the United States. So there's no regulator who can go to those banks and those institutions and those non-financial companies and those shadow banks and regulate the extension or the use of dollar collateral. And so as a result of no regulation and no oversight, there's also been no measurement. And there's been it's grown uninhibited for decades. And so, to your very good analogy, it's this spider web of dollar-based credit that's been extended from one entity to another, to another, to another. And so it's this huge opaque entity out there that nobody really knows the size of it. But it's like it exists, you can feel it, it's there, but you just can't really see it. And so that has created an incredible amount of demand for US dollars, because all of that money that exists out there, or not all of it, but very large percent of it has been loaned into existence. This conversation has so many different ways that it can branch off. You kind of need to have a basic understanding of how money is created to understand it. But essentially, without going into too much detail, the monetary system that the world runs on, and it works in basically the same way that every country, is there's base money, which is the currency and coins that you have in your pocket, and then there's reserves at the central bank. That's the only money that actually really exists. Everything else is loaned into existence and is digital, for lack of a better word. You use that base money as the collateral, which off of which everything else is loaned into existence. The only entity in the world that can create that base collateral is the Federal Reserve and the US Treasury. Those are the only two entities that can do it. There's no entity outside the United States that can create collateral.
When we talk about base money, that's the same thing as talking about the size of the Fed's balance sheet, right?
Sort of, yes. I mean, because the base money in the Fed balance sheet is similar in size. Yes. And so what happens in a debt-based monetary system is it has to grow. Because there's interest attached to it, it needs to keep getting bigger and bigger and bigger. If it starts to go in reverse, that means that loans are collapsing or credit is collapsing. That's a credit crunch, for lack of a better word. If it gets big enough, it will cause a cascade where everything will default until you get back to the base money. And if you want to, you can just dig into, fractional reserve banking or go to Google and look up how money comes into existence. Now, the reason this is important is because as long as money is circulating, or as long as new credit is being extended, the system works. The problem, like I said, is when there is no monetary circulation and when debts start to happen, the whole system starts to collapse. The only way to keep the system from collapsing is either to get the circulation going again, or to put new collateral into the system. The only entity that can put new collateral into the dollar system is the United States. So outside the United States, in this big, huge euro dollar market that's even bigger than the US dollar market, when the circulation of dollars stop or when credit starts to contract, there is no entity out there that can go in and create new collateral. And so eventually, when debt gets so big, it will eventually start to reverse and it will start to collapse on itself. It's like trees grow to the sky until they collapse, right? It's like an exponential curve. It can keep going up and up and up for a while, but eventually it's going to fall. And when that happens, that's when the Fed has to come in and recollateralize the system. They have to put new reserves or new liquidity into the market. And right now, what we have, and so the reason this is important, and I know this is a little confusing, but the reason this is important is a thesis that is called Trifan's dilemma. And what Trifan's dilemma says is that when you have a individual country's currency also act as the global reserve currency, at some point, the needs of the global economy will come into conflict with the needs of the domestic economy. And so that's what we're having right now. And that's why we have this monetary policy divergence. The needs for the United States domestic economy is tight money. They need tighter money and higher interest rates. That is not what the rest of the world needs right now. The rest of the world needs dollar funding and a weaker dollar. And so we're right in the middle of Trifan's dilemma right now. And how this gets resolved, I don't think it gets resolved without pain. And when pain happens, I think the dollar goes higher. And so again, it all kind of comes back to the dollar. To me, no matter how you analyze the economic world, you can't ignore the US dollar. And to me, any efforts that are made to solve this problem really only make the problem bigger. Because the only way to really get out of the problem is either to redesign the entire system or to let everything collapse and restart. And no government agency is ever going to, let it just collapse. That's not their role, right?
Excellent summary. I want to workshop this even a bit more because it's so fundamental. First, to your point, or I'm going to try to summarize some things and maybe pose some questions. So I just want to summarize your point about the way in which money is created is crucial for people to understand. Money, to your point, is loaned into existence, and it's loaned with an accompanying amount of interest that needs to be repaid. The destruction of dollars creates deflationary pressures that then either cause the system to go into a type of collapse, or if monetary authorities step in, they can create more collateral, and that collateral has traditionally been U.S. Treasury securities, or rather, the collateral is the dollars, but Treasury securities are the means through which that money is purchased, which is one of the reasons why the cost of funding for the U.S. government has been so cheap and why sovereign debt has grown so much. And through all of these cycles, Brent, I would say, and I think this is kind of where you stand on this, the way in which monetary authorities have met these crises of liquidity is to issue more and more dollars, to allow more and more money to be loaned into existence. And I just want to kind of add this as well. It seems to me that within the context of this thesis, what you're basically saying is that people who think that because of the nature of its balance sheet and certain qualities of the US dollar, that because of these things, people are going to stop using the dollar because they're going to so obviously see that it's a flawed currency. What these folks don't understand is that within the context of the international financial system, you're sort of trapped into using the dollar because of these dynamics. The only way in which that would change would be if there was a political change. In other words, that getting out of the dollar requires a political solution. It isn't something that's going to happen endogenously. It isn't going to happen by people just deciding to divest themselves of the currency. First of all, one, please answer if that's correct.
Yeah.
Okay, so
I think that's right.
Right. Do you think that because we've gone through so many cycles now, and I also wonder when that started. I mean, did it start after the 87 crash? Did it start after the Asian financial crisis or the 2000 bubble? I'm curious
Well, I mean, it's kind of one of these things where you can probably trace it all the way back to original sin in the Garden of Eden, right? I mean, how do you figure out where to really start? You could argue it started, in the 1960s when we started funding the war in Korea and in Vietnam. Or you could say it started in 1972 when we delinked from gold and, just went to floating exchange rates. You could say it happened when the Plaza Accord happened in 1987, and they started to artificially write down the dollar, to make more collateral available and, make the dollar cheaper. Or you could say it happened in early 2000s when Greenspan started dramatically cutting interest rates in order to fight recessionary pressures in the United States.
Well, that's what I mean. What I mean is, when did we begin as a country to respond to asset price declines with interest rate cuts, aggressive interest rate cuts, in order to support this unstable equilibrium? That's kind of what I was getting at. And what I was ultimately trying to get to is that it seems to me that we've been doing this now through a series of cycles, and the requirement has always had us go lower and lower. And now I'm really sort of stunned. First of all, I'm stunned in a way because this was entirely predictable. Lots and lots of people knew as a fact that this was going to happen. No one knew when and how it would play out. And now here we are on Thursday, May 12th, 2022. I think the NASDAQ is down over 30% or just about 30%. Interest rates are less than 1%. The federal funds rate is less than 1%.
Yep.
So the question is there any room for hiking? Is there any room for tightening? Or are we there now? Is that what this tells us? That the Fed came out and said we're raising interest rates by 50 basis points, and that we're there. We're done. This is it. And the backlash is so extreme because there's no tolerance in the system for tightening. I'm curious what your thoughts are on that.
Yeah, so this is where the milkshake theory starts to get very controversial. I think a lot of people are with me when I say that there's, in times of stress, there's a demand for dollars. I think most people can get to that point. Where I think people have trouble is when we get to that point, then they think, okay, so that means the Fed comes back in, provides liquidity, and this time the dollar really is going to die. Even though it didn't die the last 20 times they did it, this time they really mean it, right? So where the debate starts to come in is when I say, first of all, the Fed, I don't think needs to cut interest rates yet. And in fact, I think they can probably get away with a few more hikes.
Well, hold on right there. I don't want to have you lose your train of thought. But walk me through the market's reaction. And is it just that, in your view, we're at a place where the Fed needs to draw a distinction between asset markets and the real economy, and that we could see, let's say, the NASDAQ drop by 80%, but the Fed will still stay on target because their focus is on the real economy? Is that your thought process here?
Yeah, that's a big part of it. And so, there's this theory out there that Fed is an independent agency of the US government. I would like to absolve anybody of that belief, if that's possible. Anybody who still believes that the Fed is independent, I think you would behoove yourself to stop believing that. At the end of the day, the Fed is overseen by the US Congress. And as long as the Fed is playing ball, the Congress is happy to let the Fed believe that they're independent. But if the Fed were ever to do anything that the Congress did not like, they can rewrite that law very quickly. And trust me, they would. Or they would put somebody new to head the Federal Reserve to play ball. And so there's so many different little areas that are important to discuss here, Demetri. I want to make sure I don't lose focus. Part of the response from central banks to do what they've done is to, when we were having deflationary pressures, so they came in and tried to institute inflationary pressures to counteract those deflationary pressures. And the idea is that over time, hopefully, the nice way to get out of a debt problem is to inflate it away, right? And the way you do that is you hold interest rates low, and then you get the rate of inflation higher than interest rates. And let's say that you can get rates at 1%, but you can get inflation of 5%. So that's a 4% negative, real rate. And over 10 years, that's 40%. And so over 10 years, you can get rid of 40% of the debt, right? That's called financial repression. And that's been done throughout the ages. And it's no doubt the plan for many, many countries around the world. And it works really, really well. And it looks really easy when you do it on a spreadsheet. The problem is in the real world, people don't like it when their cost of living goes up and their living standard goes down, and politicians are still running around acting like they know what they're doing. It's this type of an environment where revolutions happen. And I'm not saying that to be dramatic. That is a fact. You look back throughout history, it's very, very rarely that there has been a revolution anywhere in the world where inflation wasn't a part of the reason for the revolting, right? And so politicians are nothing if not political animals. They, more than anything in the world, want to get reelected. So when we have these high inflationary pressures that we have right now, that we've seen for the last year, politicians cannot come out and say, we're not doing anything about it. They can't ignore it. Now, deep down, they may want this inflation because it will inflate away the debt, but they cannot have this inflation and get reelected, or it makes it difficult for them to get reelected. So right now, what the Fed is doing is they are fighting the inflationary pressures that they are feeling from a political perspective. And while they don't want markets to completely crash and go back to a situation where they need to turn around and bail everything out, they do want to get these inflationary pressures under control. And it's a very thin line that they're walking. I mean, they're literally walking a razor's edge. I don't necessarily think that they will be able to do that successfully, but that is what is happening. And so when I say that they can get away with it more than people think, my point is I think they are, for political reasons, they are willing to accept asset price deflation in their attempt to get consumer price inflation under control. The other thing that I think people need to understand is that when I was talking earlier about the Trifan's dilemma and the needs of the U.S. domestic economy can come into conflict with the needs of the global economy, that allows the U.S. dollar to be used as a weapon. And you've probably heard, reading some of the financial papers, even over the last year, especially over the last couple of months, is the weaponization of the dollar. And that is a real thing. And it is probably, other than the nuclear weapons that we have, it may be the most powerful weapon that the United States has. And I think a big part, and I don't think I could ever prove this, and I don't think anybody would ever admit it, but I think a part of these rate hikes and the tighter monetary policy is geopolitical in nature as opposed to purely economic in nature. If we go back to what we were talking about earlier about, we have kind of started moving from this unipolar world of great coordination to a bipolar world of great confrontation. Sides are being drawn. Whether you want to classify that West versus East, or China versus the United States, or Russia and China versus US and the West, democracy versus communism, it doesn't matter to me how you define it, but I don't think it's too controversial to say that we are being, to a certain extent, forced to choose sides. And I think that these rate hikes are putting incredible pressure on the rest of the world. And I think it's being done on purpose to a certain extent, because if you want to extract leverage from an entity, the first thing you need to do is put them in a position where they need your help or they need your assistance. And by raising rates, the United States is putting many countries around the world in a really tough spot. And they're putting them in a tough spot right when battle lines are being drawn between which side are you on? Are you with us or are you against us? Now, I want to be clear that I don't necessarily advocate this. I'm just telling you, I think that it's reality. And, I think because dollar liquidity is so important and so much needed in the global economy, the U.S. is going to put some countries in a position to say, listen, we will help you out. We'll give you a swap line. We'll help you get access to dollar funding. We'll help you with your trade problems or whatever it is. But in exchange, you are going to support us in our efforts against China and Russia or whatever it is, right? And I think that's part of what's going on right now. I don't think that the Fed cares that emerging markets are struggling. I think they're actually happy that they're struggling to a certain extent. So my point is just because markets have started to come under pressure, I am not of the belief that we are going to see an imminent reversal of course by the Fed. Now, if markets get bad enough to where the system starts to collapse, then yes, they will absolutely reverse course and do what they have to do to save the system. That is why they are put in place. And so I think a lot of times when people say, well, they shouldn't do that, they should just let the system burn down. It's not moral to bail out the bankers with the taxes from the citizens. And that's fine. We can agree on that. But it's important to understand that it doesn't matter whether it's right or wrong. This is what's going to happen. That's why the Fed exists. That's why central banks around the world exist. They were put in place to be the lender of last resort and to support the system when the system comes in under pressure.
So that's interesting because that actually runs counter to what my instinct is around the extent to which coordination exists between the central bank and the government. I do think that the central bank is a political animal, but what you're describing here is actually not really political calculations on the part of the Fed. What you're describing is a kind of deep state relationship that might actually run counter to what the Biden administration itself wants, right? Because if the executive branch is interested in re-election, they're not really interested in cratering the global economy. They do want to get inflation under control. And this sort of speaks to the Siphian dilemma that the central bank is facing and that the executive branch too is facing. But how, kind of walk me through that exactly. Who would be driving the train here on Fed policy if that's the case? What's the centralizing sort of intelligence that's informing policy at the Fed? Because I would push back on this thesis.
No, that's totally fine. And the thesis may be completely wrong. I don't have proof of this. And I don't think anybody, even if I was right, I don't think anybody would tell me. I don't think anybody would come out and say, yes, that is actually happening. And no official source, I think, would say this. So this is where it also gets a little confusing of who's driving the policy here. Now, the Fed is in charge of monetary policy. That is true. And so, the Fed, because they're quasi, so to speak, independent within the government and can make their own decisions, there's nothing to say that they couldn't, do something opposite of what the Biden administration wanted from a monetary policy perspective. But the other thing that many people probably don't know is that dollar policy is determined by the Treasury. So whether the Treasury wants a strong dollar or a weaker dollar, they typically say they want a stronger dollar. I think sometimes they would prefer to have a weaker dollar, but they typically always say they want a stronger dollar. But, the Fed and the Treasury will work in concert to try to get the Treasury's desires for the dollar. And not only that, but the Treasury has their own working group, and they have a thing called the Exchange Stabilization Fund, where they have money where they can go out and actually active in foreign exchange markets to either push dollar prices up or dollar prices down.
I'm laughing because I'm remembering Ron Paul grilling, who was it? I don't know if it was Geithner. I don't know if it was his predecessor. Probably all of them, because every Treasury secretary always says they want a strong dollar.
Right.
But it's the central bank that I think ultimately, I think you agree on this too, is the decider of whether or not, to the extent that there's a decider, of whether there's going to be a strong dollar or not. But I guess what you're saying is that you think, I don't know. I mean, sorry. I mean, I didn't mean to. I interrupted you because I was laughing, and I wanted to actually be clear about why I was laughing, because I was remembering Ron Paul, because that was a bygone era. But I guess I don't know. I'm not fully.
You're actually. There is tension. Believe it or not, there is tension between Treasury and Fed. A lot of times people think that they just work hand in glove, and because Janet Yellen was the former Fed secretary and now she's Treasury, that her and Powell are probably 100%, on board. It's like hand in the glove. It's perfectly coordinated. And I don't think that's the case. I think that there is pushback between the two different agencies. I'm just saying the Treasury, just so people know, the Treasury is in charge of dollar policy. Fed is in charge of monetary policy. Sometimes those work in concert, and sometimes they do not. But I would argue that both the Fed and the Treasury, their number one priority is to get Biden reelected and to keep Trump out of office. Now, you may disagree with that. That's fine. But I think that is true. I don't think that they want a Republican administration, and I certainly don't think that they want Trump back in power. And since the biggest current knock against Biden is inflation, what are you doing to combat inflation? And so I think that as a political animal, the Fed and the Treasury are trying to get that under control. And if the byproduct of that is pressures on countries outside the United States, so be it. Maybe all the better, because then we can use that as leverage as well in any other kind of negotiations of a geopolitical nature.
I completely agree with that. I think that they're all very unified on not wanting Donald Trump to win the election. Let's actually stay on this kind of larger point around interest rate hikes and geopolitics, because it also speaks to the complexity of the situation, because these interest rate hikes are not good for anyone outside of the United States in terms of financial stability, and certainly not the Europeans. It makes their situation more difficult. Are you also suggesting that what the Fed would do in this case is that it would use its swap lines selectively to support the countries that are with it on U.S. foreign policy objectives and withhold dollar liquidity for countries that aren't? And what does that mean for the value of the dollar and the dollar milkshake theory moving forward?
I absolutely think that they will use that as a political tool. No question in my mind. You don't just get a swap line because you want a swap line, right? We give swap lines to countries that are friends of ours, for lack of a better word, or who we want to. China's not going to get a swap line. Russia is not going to get a swap line. Turkey potentially could get a swap line because they are so geopolitically important, but they are not going to get a swap line while they're buying Russian missiles and pointing them towards, or threatening Turkey is so weird because it's a NATO member, but they've been very friendly with Russia and have bought, SAM missiles from Russia, et cetera, et cetera. So, that would be an example of a country that could potentially get a swap line at some point, but they're not going to do it without the U.S. extracting its pound of flesh. And so what does this mean? It means that there's going to be the haves and the have-nots. And I think the U.S. is going to drive a very hard bargain. This is partly of how they are going to re-exert their dominance as the global hegemon. There's this scene out of a movie that has Christopher Walken in it, and he's telling this story about the lion. The lion's, it's just laying there on the Sahara, out on and it's hot, and he's laying there in the sun, and the flies are coming around him, and the lady lions come up and kind of swat him, and he just doesn't pay any attention. And then the hyenas come in and start nipping his heels, and he doesn't pay any attention. And then finally one day he's just had it. He just gets up and he just beats the crap out of all of them, right? And then he goes and lays back down. And I think that's a good analogy for the United States right now. And I think a lot of people think that we're in a weakened position. I think a lot of people think that the U.S. no longer has the ability to exert force around the world. I think a lot of people think that our economic situation behooves us or keeps us from acting in a way that we would otherwise like to. And I just fundamentally disagree with that. And I think that the U.S. is in the process of, kind of showing the world how much power it still has. And I think it's just getting started. Now, I will be happy to be wrong on this. The things that I foresee and that I am talking about are not things that I want to see happen. I'm not saying that this is what I advocate. I'm not saying this is the moral thing to do. I'm not saying that this is, a great plan. I'm just explaining how I think things are going to play out and why they're going to play out that way. At the end of the day, the power is the most important thing. I mean, if you really get down to base, effects or what do you call them? The elemental, fundamental level, whoever can exert the most force wins. And the U.S. has an enormous amount of ability to exert force, both economically, politically, and militarily. And because we are moving from what I believe is a unipolar world to a bipolar world, I think the U.S. is going to use all tools that it has available to keep itself at the top of the mountain. And it's very possible at some point that they will fall from that point of the mountain, but they are not going to willingly walk down that mountain. I think they will do everything that they possibly can to stay up there.
So this is actually something I'm very interested in talking about, because it pulls in so many threads from so many different conversations that we've had on this podcast, especially because we've done so much on geopolitics. But I'm going to save that conversation for the second part of this episode, Brent. I also want to stress test some other theories as well, including Zoltan Pozar's Bretton Woods 3 theory, because it's gotten a lot of popularity or a lot of traction. and in some ways runs counter, I think, to either it runs counter to the dollar milkshake theory, or it brings forward a lot of what you believe would happen into the present without necessarily requiring some other kind of event. I'm not sure exactly where he stands on it. Zoltan also kind of, his writing is itself difficult to understand sometimes.
Yeah.
There's also this divide that kind of I've noticed, I guess, primarily on financial Twitter, between those who sort of generally fall within your camp and those who generally fall within a camp that says kind of the US dollar is, I'm trying to think of a way of describing this without resulting to saying things like the dollar's a shit coin, the US is a profligate, deficit running, squatter on the international. Yeah, exactly. And one of the areas where I've seen this play itself out is in conversations around the exchange rate between the US dollar and the ruble, the power of energy exporters in the international system, their ability to exercise leverage in the sanctions regime, et cetera. That's also something I'd like to try and pick apart with you as well. And finally, I want to try and understand how you're playing this market today, Brent. What does your positioning look like? What are you looking for in terms of entry points in equities, commodities, especially oil and gold? And what do you think it would take to get us there? For anyone who is new to the program, Hidden Forces is listener supported. We don't accept advertisers or commercial sponsors. The entire show is funded from top to bottom by listeners like you. If you want access to the second part of today's conversation with Brent, as well as the episode transcripts and intelligence reports, head over to hiddenforces.io and check out our episode library, where you can also become a premium subscriber today. Brent, stick around. We're going to move the second part of our conversation onto the premium feed. For more information about this week's episode, or if you want easy access to related programming, visit our website at hiddenforces.io and subscribe to our free email list. If you want access to full episodes, transcripts, and intelligence reports, which include additional notes, resources, links, and other material that will help you get the most out of each and every episode, check out our premium subscription, available through the Hidden Forces website at hiddenforces.io. Today's episode was produced by me and edited by Stylianos Nicolaou. For more episodes, you can check out our website at hiddenforces.io. Join the conversation at Facebook, Twitter, and Instagram at Hidden Forces Pod, or send me an email at dk@hiddenforces.io. As always, thanks for listening. We'll see you next week.